Welcome and get ready to dive into the thrilling world of investments, where numbers dance, money talks, and the unexpected always keeps us on our toes. If you're an investor searching for the perfect blend of growth and dividend income, you're in for a treat today. We've got an ETF that not only strikes that balance but also outperforms some of the most popular dividend ETFs out there. So, fasten your seatbelts and get ready for an exciting journey. When it comes to choosing the best dividend income ETFs, investors often prioritize a few key factors. First, capital appreciation. While high dividend yields can be tempting, long-term investors understand the importance of their initial investment growing over time. It's the growth potential that truly matters. Next is dividend yield. Of course, a strong dividend yield is attractive, especially for those relying on dividends for income, like retirees. Third, frequency of dividends. Monthly dividend payments offer advantages over quarterly or annual payouts, ensuring a steady income stream, which is crucial for covering day-to-day expenses. Lastly, strong dividend growth. Monthly distributions provide more opportunities for reinvesting dividends, potentially accelerating overall returns and helping buffer against market fluctuations. These factors are the foundation of a successful long-term investment strategy that delivers outstanding performance. So, we searched the ETF landscape to find an option that excels in all these areas, and we discovered something truly exceptional: DGRW, the WisdomTree US Quality Dividend Growth Fund ETF. This hidden gem combines them all, a winning formula for smart investors. Before we dive deeper, let's cover the basics of this ETF. DGRW was launched in May 2013 and has a respectable track record. It manages $9.8 billion in assets and comes with an expense ratio of 0.28%, which means you'd pay $28 annually for every $10,000 invested. Now, let's talk about performance. Year to date, with dividends included, DGRW has delivered a return of over 10.1%. It has outperformed one of the most popular dividend ETF, SCHD, by a whopping 10%. Since the fund's inception, it has consistently outperformed SCHD by almost 20%. That's a performance worth celebrating. Here is another chart which shows how the fund has performed versus SCHD over different time frames. It has always beaten SCHD in terms of price performance. How does DGRW achieve this outstanding performance? Well, it's not your typical dividend ETF. DGRW tracks the performance of an index that invests in large and mid-cap dividend-paying U.S. common stocks with growth characteristics. DGRW focuses on potential for dividend growth as opposed to backward-looking dividend increases. With the goal of increasing coverage of firms likely to be larger players in the dividend market, it mixes forward-looking earnings estimates with historical return on assets and return on equity growth in its selection process. Think of DGRW as a financial detective that searches for the most promising dividend-paying stocks in the U.S. market. Instead of looking at what companies have done in the past, it tries to find the ones that have promising dividends payout in the future. To discover the ideal companies, DGRW relies on a special formula that brings together three critical factors: earnings estimates, return on assets, and return on equity. This is the triple-check system to find the cream of the crop in the business world. Here's how it works. Earnings estimates. This forward-looking metric predicts a company's future financial performance. DGRW examines what experts foresee in terms of earnings, which will translate to a company's future growth down the road. Return on assets. This metric assesses how effectively a company has managed its resources in the past. It measures if a company is making smart financial decisions. Return on equity. This is another piece of the puzzle, providing investors with insight if the company knows how to put its capital to good use. DGRW takes all three metrics into consideration when it includes a stock in the ETF. By combining these three elements, DGRW aims to spot companies that have not only demonstrated financial success in the past, but are also well positioned to continue to grow their business in the future. Once DGRW has a list of candidate companies, it ranks the top 300 names based on the combined ranking of these three factors for inclusion. Stocks projected to pay more dividends are weighted more heavily, with individual weights capped at 5% and sector weights at 20%. The index is rebalanced and reconstituted on an annual basis. DGRW prioritizes high dividend stocks, capping individual stock weights at 5%, except for the top two, to ensure diversity. It undergoes annual updates, similar to refining your investment strategy, with the index refreshed to include the latest market stars. It's like updating your investment playbook to stay ahead of the game. The index it follows goes through a process of rebalancing and refreshing to make sure it includes the latest and greatest companies in the market. How does DGRW allocate its capital across the sectors? Technology takes the crown overall, with electronic technology taking 17.8% of the portfolio, followed by technology services at 15%. Then you've got consumer non-durables at 13% and finance and health technology at 10% respectively. Looking at the fund's top 10 holdings, it is not surprising to see Microsoft and Apple carry the most weight inside the fund, with 8.68% and 5.69%. All the remaining stocks in the fund stay below 4%. There are many familiar faces, such as Johnson & Johnson, Broadcom, Procter & Gamble, Home Depot, Merck, Cisco, Coca-Cola, and Walmart. Since the fund's remarkable growth is tied to its strong focus on the technology sector, you might question its ability to protect investments in challenging times. Tech stocks are known for their price volatility, which may raise concerns about asset vulnerability. When we examine DGRW's performance during the 2022 bear market, we are thrilled to see this ETF was able to offer outstanding asset protection while the broader market was in double digits decline. In 2022, the S&P 500 index declined almost 20%, while DGRW had a loss of just 6.35%. That is a big win for DGRW. Although DGRW fell behind SCHD for this period, the difference is quite small, making it a close race. This is exciting because it shows DGRW not only provides great protection in a declining market, but it also offers better growth opportunities when the market turns around. This is a fund that can navigate both calm and stormy financial waters. Despite its remarkable track record, DGRW has far less assets under management compared to SCHD. We think it boils down to a crucial factor: the dividend yield. A solid long-term investment grows your money and provides extra income, especially in challenging market times like a bear market. This extra income serves as a financial safety net, and that's probably why so many investors choose SCHD, because of its higher dividend yield. Nevertheless, DGRW is still amazing because it emphasizes growing future dividends rather than chasing the highest yield right now. It's like sowing seeds for future financial security and growth. It also pays out dividends every month, which allows you to reinvest more frequently and to maximize the benefit of compounding, compared to quarterly dividend payouts. This can speed up the growth of your investments over time. Now, here's where it gets really interesting. Instead of getting fixated on the size of those dividends, I believe it's even more important to focus on something else: dividend growth. Imagine this: a company that keeps boosting its dividends isn't just financially sound, it's like a magnet for long-term investors. They're drawn to it, and their interest can push up its value. Take a look at this chart. It shows the DGRW's dividend growth rate, and it's impressive. Over a 10-year period, it grew by 27%, and in 5 years, it increased by around 8%. Now, check out this other chart displaying how DGRW's dividends have grown since the beginning. It's a steady, upward climb, just like SCHD's dividend growth. So, the bottom line is this: the fund might not have the highest yield out there, but it's setting the stage for growth. And that's what really matters. It's like a mix of security and potential that can make your investments shine over time. The current Sharpe ratio for DGRW is 0.77, outperforming SCHD's Sharpe ratio of 0.16. The Sharpe ratio is like a yardstick for measuring how much risk an investment takes to provide desired returns. A higher Sharpe ratio indicates that you're getting better returns for the level of risk you're taking. It's a valuable metric to assess your investment's performance in terms of risk and reward. Overall, DGRW is an exceptional ETF that offers impressive growth alongside reliable risk management. While its dividend yield may not be the highest, it compensates with consistent dividend growth and monthly distributions. With a strong track record and a unique strategy, DGRW is a worthy addition to your investment portfolio. Remember, investing is an ongoing journey, and your preferred ETFs may change over time. Keep learning, maintain diversity, and enjoy the benefits of both dividends and capital appreciation. If you found this video valuable, please don't forget to like and subscribe.